Every Joe Blow financial advisor has told you that if you want to create wealth or grow your wealth, you need to invest in low-cost index funds for the long term. And yes, if you are interested in creating wealth 20, 30, 40 years from now, that's the way to go. But what if I told you there was another way to invest that instead of making a big impact on your life decades in the future, could make a massive impact on your life today? Hi, my name is Stephen Brooks, and if you don't know who I am, I'm a hedge fund manager who specializes in cash flow strategies, specifically in the S&P 500. Now, I'm not saying that the low-cost index fund buy and hold strategy is not for you, but I've always looked at my capital as an asset that should be paying me today. I never really cared about growing a big number on a piece of paper and having it impact my life when I'm much older and, respectfully, physically unable to enjoy life in the way that I am right now. So the investing strategies that I use are meant to produce cash flow for me today. So if you're interested in having your capital impact your life today by providing cash flow to you, then this video is for you. A cash flow strategy is a short-term trading or investing approach where you repeatedly put your capital at risk in situations that have a positive expected value with the goal of generating consistent cash flow. Think of it like a casino. Every time they deal a hand of blackjack, they have a 42 basis point mathematical edge. Their goal is to get you to bet more, or their goal is to get more people to play more hands. So here's a strategy that we run where the average win is essentially the same size as the average loss, but it wins a little bit better than 54% of the time. That comes out to a positive expectancy of $21 per contract per trade. So what we do is we essentially we spam bet this every single time it's available, which is us risking our capital every single time there is a positive expectancy. Now, this particular strategy is the average type of strategy that we run. We trade the S&P 500 and the expirations that expire the same day. So our capital is at risk until the market closes at the most. And when you utilize these types of strategies with relatively high frequency, that is when capital turns from something that appreciates over time with inflation and GDP into something that can produce cash flow for you in the very short term. And while compounding is a very big factor in the returns that you're going to get on something like a low-cost index fund over 20, 30, 40 years, the compounding here in many cases is daily. Historically, we win about 2 out of every 3 days, which means we have the potential to compound much more frequently than something like an index fund. Now, what this does do with these types of strategies is, number one, it allows us to have returns that are not correlated to the S&P 500. The majority of the moves up or down in the S&P 500 happen during periods of time when the market is closed. With strategies that we run that are cash flow specific, we don't have any exposure to the aftermarket or the pre-market. Number two, these types of strategies don't have any bearing on when the market goes up or down. Sometimes they do well if the market goes up, and other times they do well if the market goes down. So they're not correlated. And the total that you could see right here, based on that lack of correlation, has allowed us to outperform the market by 22% over the past 6 months. So if you are an accredited investor and interested in having your capital become an asset that produces cash flow for you, there will be a link below this video where you can express interest investing in our fund. Or if you're someone who wants to do this on your own and you're not yet accredited and you want to use our software that'll place these trades on your behalf, there will also be a link below this video that you can go ahead and click on as well.